Our next presentation is going to be the U.S.-China Economic Market Update, focusing in on the trade and investment trends occupying the U.S.-China relationship. So we're very delighted to welcome Mr. Chris Zheng, Principal at the China Desk at RSM. Chris, thank you for joining us.
All right, good morning, good evening, everyone. Like Colin mentioned, Chris Zheng, I'm based in Chicago, part of the RSM China desk. So I will spend the next 20 minutes or so to talk a little bit about China and U.S. trade and investment relationship and trends. I hope these talk can provoke some thoughts. Like Mr. Lee, I actually listening part of Ms. Lee's presentation. There's really no crystal ball here, but hopefully we can provoke some thoughts through these conversations, and using old Chinese verb like cast a break to attract jade. So hopefully we all can brainstorm some of the conversations. So really on the trade and investment side, U.S. and China are #1 and #2 largest economy in the world. The trade relationship between the two and investment relationship, no doubt, have a tremendous impact on the global commerce and trade. Right? It's the trade relationship in the last few years has really shifted significantly. As you can see on the title, it's really as a critical junction. The tension has increased across multiple dimensions between the bilateral relationship. The tariffs is at the decade high on both sides. Really, not only on the U.S. side, but also on the Chinese side. Historically, both U.S. and China benefit significantly from the combination of the trade flow and the supply chain. The export to China created 1.2 million jobs in U.S. and U.S. as up to 2017, 2018 was the #1 trading partner for China. But really, since 2017, 2018, with the tariff kicking, the trade are deteriorated significantly. The trade figure for 2019 and 2020 dropped really 35 to 40% from the multi-year average. It's really kind of not only caused by the tariff, but also the pandemic is one of the big reasons driving these downturns. But on the flip side, it's really not all that pessimistic. U.S. and China remained one of the most important bilateral relationship. U.S. still is the largest trading partner to China on a single country basis. Even though on the combined basis, U.S. is lagging ASEAN and EU as a bloc, but really U.S. is still that homogeneous market, single country market that China has a trading relationship with. And for U.S., China is still the #1 import country in terms of goods. The #3 other than the North American trading, the old NAFTA countries, Canada and Mexico. So China is really still remain very important trading partner, even though with all these factors, tariff and the pandemic. On the investment side, it's a very similar story. 2020 is a very volatile year. The investment, FDI investment in both directions slowed since 2017. And in 2020, U.S. To China investment dropped to 8.7 billion. That's the lowest since 2004. And then China to U.S. FDI also dropped from the 2016 high to around $7.2 billion in 2020. So similar to the trade, on the investment side, beyond FDI, really looking beyond FDI, there's still very strong ties between the two countries. You can see the Chinese hold 1.4 trillion debts of the U.S. and also 720 billion in the equity market, which is the stock market that China invested in U.S. And on the flip side, even though the U.S. investors holds very little debt, it holds 1.1 trillion in the Chinese equity market, which the fund that invested in the stock index in China. The other activity remain very relatively strong is the venture capitals. The private investment really kind of whether it's early funding or the late run of funding of the venture capital remained relatively strong and continue to spend. So I guess really what I'm trying to get on this slide is really there are two sides of the trade and investment. Even there are a lot of challenges between the two bilateral relationship in terms of trade and investment. The fundamentals remain strong because the ties between the supply chain and the financial market. So let's look a little bit on the trade. So like I mentioned, China really remained the third largest good export market in 2020. In 2019, the U.S. exported about 105 billion in goods to China. Last year, that number really jumped to 124.5 billion. You can see on the slide. This is second highest amount in a decade. Partially driven by the phase one agreement between China and U.S. The major category of export from U.S. to China are oilseeds, grains, the oil and gas product, semiconductors, and those are really the major growth areas. For example, in Texas alone, the export of oil and gas amounted 4 billion. Illinois, Iowa, some of the traditional agriculture belt states exported, exceeding of 1 billion oilseeds and grains. In Oregon, one of the biggest semiconductor were in U.S. that reside, exported about $2 billion of the semiconductor. So really strong showing last year. In terms of Indiana, I believe Indiana was number 5 on the list of the state. It exported around 3.9 billion, and really the top category are pharmaceuticals, oilseeds, medical equipment, and I think the auto parts is one of the biggest export source for Indiana. Really, if you see the China to U.S. export, it's mostly remained flat, at the 434 billion. And this is really equivalent about 16-17% of total U.S. imports. The top category, China exported to U.S., including electric machines, the furniture, bedding, toys, and sports equipment, and a lot of chemical-related plastic products to U.S. So it's really still a lot of the consumer industrial products where China has strengths in terms of cost and supply chain. So which really kind of helping U.S. To stabilize the price in those categories. So one thing not I want to call out is the 2021 year to date. We see even stronger showing. You see this is up to August, 313 billion. Usually, you can expect the September to December due to the shopping season. Those are high import months. So really, if not due to supply chain issues, I believe the number of 2021 will surpass 2020, which is a big rebound in terms of the trade relationship. One thing really not showing on this chart is not really in the statistic are the service-related trade. China is really the number one of the top service trading partners for U.S. And in 2019-2020, it surpassed $50 billion. A lot of those sources are coming from the students, the education, the travel, and also the kind of the professional services that U.S. exporter provided to Chinese companies, whether it's a listing on the stock market or getting the capital of funding the growth. Or I think Mr. Lee, like law, right? A lot of the professional service, that's one area not really in the statistics, but U.S. traditionally very strong and has a net benefit in terms of trade with China. See, there's a chat. Okay. So Colin, feel free to stop me. I can't read all the messages while I'm talking.
Okay, I'll let you know when we get Q&A submissions.
Okay, sounds great. So really on the investment side, the U.S. FDI to China in 2020 is about 8.7 billion. China to U.S. is 7.2 billion. They're relatively equal. In terms of VC is 2 billion, 3.2 billion. So let me break down these numbers a little bit more. Really, in terms of the FDI to China, the 2020 is actually around a 33 or 30% drop versus 2019. It is at the lowest level, like I mentioned earlier, since 2004. And this is below the average of last 10 years. Really, there are two parts of this FDI. One is really the greenfield investment. The other is the kind of expansions. Even though these numbers are a little bit still, 2020, we actually, UN actually just released FDI worldwide this morning. The investment activity worldwide actually increased 70%, recovering from the pandemic. So these numbers actually skewed a little bit because we don't have the latest data. from what I see, the U.S. and China investment rebounded as well, being the #1 and #2. China being the #1 FDI destination, and U.S. being the #2 destination. So we do see some of the big rebound. For example, Tesla just announced second phase of their expansion in China of the gig factory, or the giant factory in Shanghai. And then also there's some new project breaking ground, like Ford just announced their establish of blue mark technology in Nanjing, China, which is related to the new energy vehicles research. So there are a lot of activities happening in the investment side. The investment to China for U.S. is still relatively concentrated in the automotive, in the consumer goods, in the more recently in the high tech industries. So the major investment for U.S. to China is still concentrated to coastal areas like Shanghai, Zhejiang, and Fujian. Those areas is still not moving inland as some the research predicted. So I guess really a few comments really here is the FDI of US has mix of FDI has shifted really significantly over the past 3 decades, right? Once after China opened its market to the world, really initially really focused on labor intensive manufacturing, which we outsource, US outsource the manufacturing to China, where the goods are sold back into the development market. So we can, it's used as a vehicle to decrease the cost of manufacturing. And in the 2010 stage, in the last, that first 10 years of the 21st century, really, it shifted to more access to Chinese market. So a lot of the automakers, a lot of the consumer goods manufacturing are investing in China to gain a share of the Chinese market. Really, you know, we talk about GM, Ford, a lot of the auto OEM invested heavily in China to gain a share of the local market. So in the last 5 years, we see a lot of the high technology investments, right? Whether that's car sharing, the digital payment business. There are a lot of ByteDance, right? The TikTok. Really, there are a lot of the shipment to both kind of addressing the Chinese market, but also the external market using China as a base. So it's really kind of those 3 stage, not diminishing labor intensive and access to market are still very important, but we are see a trend toward leverage Chinese company as a growth platform, not only in China, but globally. So really the next slide, this is actually my last slide. This is a crystal ball slide. We want to talk about, you know, the U.S. and China, like I mentioned, the U.S. and China relationship remain the most important one, but it's really a two-way street. It really takes a two-party to continue to stabilize and improve this relationship. And the as I mentioned, even though there are a lot of challenges between China and the U.S. In terms of trade and investment, the fundamental remained relatively strong in the short term. But really, it shows the resilience of the trade and the business relation between the two countries. However, the long term, there are some uncertainty among the long term relationship between the two countries. Uh, you know, the really there you can see these five buckets. Really, number one of these uncertainties is really the policy. Whether those policies, some are more political, some are more trade related. For example, the tariff, right? There are a lot of uncertainty. That there are some positive development in terms of policy. U.S. actually granted further exemption of tariff from the for Chinese goods, right? Even we're leaving a high tariff, but we also allow semiconductor like Intel export more advanced chips, so long they're not impeding on the trade embargo list. The number two driver is really the market. There are a lot of challenges on both sides in terms of domestic and the global market. From domestic market, U.S. facing we're trying to pass the construction bill, the budget now set, the inflation, the supply chain issue, and the debt ceiling, right? There are a lot of uncertainties in the domestic market. On the flip side, China really tightened some of the policy toward the technology giant recently, trying to clean the debt, the Evergrande issue recently in the real estate space, as well as some of the energy issues, right? The constraint of the supply of the electricity, natural gas, and coal. So there are both challenges domestically. Like China, the Q3 growth is at 4.9%, just announced as of September, which is 2 to 3% below the forecast, which shows the challenges in both two markets. The other obviously is this pandemic, right? The Delta variant is coming, make a comeback. Especially, I wouldn't spend too much time on it, but it really kind of put another uncertainty in the mix. The other is really the supply chain issue. We all read like there are hundreds of boats out of West Coast. It's backing up the supply chain. I actually have a client, they charter their boat from China to move their goods. And they only found out when they get to US, they cannot unload them. It's still stuck at the port, even though they charter their own boat to get the material and goods out. So the supply chain really is more a medium-term headwind. Maybe in a year or 18 months, we'll flash through the backlog. The other is really the combination of the pandemic and supply chain. It's not really limited to China and US. For example, Vietnam, with the trade war, Vietnam, a lot of the supply chain moved to Vietnam, but Vietnam has the outbreak recently and is significantly interrupted the supply chain, which caused the kind of both the trade, it caused some of the readjustment between the trade relationship of China and the U.S. There are actually more order going to China and cause further supply chain strain and energy strain to China. And then the last but not least is really the geopolitical factors, where China just signed the RCEP, the mutual investment agreement with EU. U.S. is playing a major role in North America and the other parts in the world. So these are really the headwinds that your uncertainties on the U.S. and China relationship, trade and investment relationship. I mean, if I have to put a crystal ball, I feel there are fundamentally what works for the relationship is so important and so fundamental. So neither side can just give up this relationship, even though there are a lot of the challenges and the economy are really intertwined. So I remain optimistic. We will work out the challenges, right? The pandemic, the supply chain issues. But I really believe in the long term we will get to some form of normal to continue the development of the trade and investment relationship between the two sides, which really going to benefit not only U.S. China, but really the global commerce and trade. So I think that's about all I prepared remarks. Colin, I don't know if there are any questions.
Sure. Yeah, we actually have a few submissions. But Mr. Zhang, thank you very much for the very detailed presentation. So the first question comes from Tiang Zhang, who asks, was there a breakdown among the contributions of the export values from China to the U.S.? For example, how much was it done by foreign enterprises, which I assume is U.S. enterprises? How much was it done by Chinese enterprises? And how much of it by joint ventures?
Right. I believe I've seen some data. I don't have it right now. They're really, I think to Chang's point, they're really like 3 or 4 categories. One is the U.S. investment in China, or GV, right? A lot of GV, like actually a lot of these GV over the years switched to supply using GM as an example, right? They supplied local market. The other there's a big portion are like companies like Foxconn. They export Apple iPhones. They're kind of they're not a Chinese company per se, but it's kind of residing in the Chinese market. So I think they are. It's probably I think that the GV and the foreign enterprise account for a significant amount of the export, even though I think the share of the Chinese company growing, especially with e-commerce. If you look, like recently, there are several big company. Actually, I'm using one of them, Anchor. It's Shenzhen-based electric company. If you go Google them, they become multi-billion just to selling on Amazon. So there are a lot of direct channels to U.S. consumers now from China, which driving some of these surge in the export from China as well.
Wonderful, Mr. Zhang. Another question is, are you able to describe the model U.S. investor in China?
Yeah. Can you repeat the model?
Yes. So I think what they're looking for is, in terms of the Chinese regulatory environment, what is kind of the model U.S. investor in China?
Okay. Yeah, they're really the traditional way is GV. I think the question. There are certain regulatory requirements you have in certain market. You have to be a joint venture. The China actually with I think with EU deal, right, the investment deal, and I think intended for phase two discussion, they will be opening more market up, but there are areas already opened in terms of direct and fully owned. For example, uh, uh, Tesla. I use that. It's not a GV. It's a subsidiary. It's a direct owned subsidiary of Tesla in China. Exxon is building a big factory. Plan to build a big factory in southern China. That's also a direct. So in the auto chemical space, they're opening. You have the opportunity to do the direct investment. The other model, the other industries start to open up is financials. The financials is really BlackRock just gained the licensing providing financial services in China solely. It used to be has to through GV. It also the Morgan Stanley recently acquired licensing to operate in China as a independent foreign company as well. But traditionally, the way to go to China is to find a local GV partner where you can partner it not only for the access to the local market, but expertise of the Chinese navigating the Chinese regulatory requirements and also the kind of the expertise of domestic market.